welcome to another video of fundamental analysis. In the previous video, we learned how we need to do fundamental analysis, as in an overview of the company before jumping into the financial statements. Now that we know the step one, we will go into the step two. Suppose we figured out a company which passes all the parameters that we had set in step one, that is basically the overview of the company. Now we decide to jump into the financial statements. So there are three sorts of statements: income statement, you can also call it profit and loss statement, cash flow statement, and balance sheet. So in this video, we are going to learn about the income statement. Let's look into a general format for the income statement. So this is a general format, and whenever you are seeing an income statement, it won't be only of that particular year. It would contain at least 5-6 years or at least a few quarters, through which you will decide if the income statement is good enough and you should go on with other statements. So let's try to understand this format. The first thing that you will look is the total revenue. What was the total revenue that was generated by that company in that financial year? Now, from that total revenue, you will subtract the variable and fixed cost. So what is variable cost and fixed cost? For example, take that a company has a factory. The factory has rent and electricity due every month or every year. So that is a cost which is fixed. The company knows that this cost would be there and it wouldn't change. So that is called something as a fixed cost, right? Variable cost can be something, for example, the company uses a machine to produce certain products, but that machine broke down, and the machine does not break down every year, right? It will break down once a while. So to repair that machine, a cost is included, and that is something which the company was not expecting, but it eventually had to come into the picture. So that can be considered something as a variable cost. So once you subtract the variable and the fixed cost, the next thing that you get is EBITDA, and this is a very popular term. If you follow the news or something, and whenever there are any results out for any company, they show you this term EBITDA. Or if you start looking into sheets, or if you start following news from now on for any company, you will probably come across the term called EBITDA. EBITDA stands for earning before interest, tax, depreciation, and amortization. You probably know what interest is, you probably know what tax is. So depreciation and amortization are things basically that depreciate in value. Depreciation is something which can be tangible, and amortization can be something which is intangible. If you want an example, let's consider the company bought 3 trucks of the 2020 version of 3 trucks to deliver its products. Now, because it's a truck and the years are going ahead and the new versions of that truck is coming every time, the value of that truck would probably go down, right? So that's basically depreciation of something that the company has. Now that you have the EBITDA of the company, the EBITDA shows the profitability of the company. The EBITDA is again, as I said, it's a very important part of the income statement. Now you subtract D&A from EBITDA. That gives you EBIT, that is earnings before interest and tax. You have an EBIT figure. Now you subtract interest from it, you get EBT, that's earnings before tax. Then you subtract tax from it, you get EAT, that's earnings after tax. So this is the actual earning that the company has after all the things that could be subtracted from it. Now the company subtracts preference dividend. So preference dividend is not something what you and I get as dividends. No. Preference dividend is solely for preference shareholders. Now this can be a separate topic completely where we can talk about preference shareholders. We won't be talking about that in this video, but just to give a gist about it, preference dividend is given to preference shareholders. And preference dividend is compulsory. Unlike us, the dividends that we get is not compulsory. If the company decides that they do not want to give us any dividend, that's completely fine. But for preference shareholders, dividend is compulsory, and it's called preference dividend. And that is only possible in the case if the company has issued preference shares. And it's not compulsory or it's not necessary that every company issues preference share. Probably a lot of companies do not even have preference shareholders, or it hasn't issued any preference shares. So this part can be zero altogether. Once the preference dividend is subtracted, we finally get the profits that are available to equity shareholders. So you and I are basically equity shareholders. Whatever profits have been attained after all these subtractions would be available to us. Right now, with these profits, the company would decide if they want to pay out some dividends or if they want to reinvest it into the company for the company to grow. And in case the company decides to pay out some dividends, we subtract equity dividend then, and then we get the retained earnings. Now this might sound a bit complicated to you, so for making it simpler and for a better understanding, we will look into an example. So we will look into an example. If you want to check out income statement of any company, you can go to Money Control. It's a very good website, but I prefer something called Tickertape. Tickertape is very user friendly according to me. So let's go to tickertape.com. Now let's search for a company, let's say Motherson Sumi. Okay, so here you go to financials and select income, and this is the income statement, right? So the first thing that you can see is obviously total revenue. Let's just look into 2020, how the company has performed in 2020, right? So the first thing that you can see is the company has a total revenue of 63,825 crores. You see, this is the total revenue, right? So these are the fixed and the variable costs. And once you subtract all that, you get something called EBITDA. And EBITDA is 5,489.5 crores. Now they have subtracted depreciation and amortization, and they have shown something called PBIT. So what we learned is EBIT, that's earning before interest and tax, and what they are showing here is profit before interest and tax, that's PBIT. They are not exactly the same, but you can definitely consider this as well. So let's look into PBIT instead, and that is 2,711.5 crores. And from that we subtract interest. So we get PBT. PBT is 2,112.9 crores. And now from that we subtract tax and we finally have the net income. So the net income is 1,170.1 crores, right? So this is the net income. This is the total amount after all the deductions that the company has earned. You see three more things here: EPS, DPS, and payout ratio. So I thought I would cover these parts in the ratio videos, but let me just give you a gist about it. EPS stands for earnings per share. So if you had invested 147.25 rupees in Motherson Sumi, for that 147.25 rupees, the company has generated 3.70 rupees as profit. Right? How do you find out EPS? EPS has a very simple formula: profit available to equity shareholders divided by the total number of shares. So that would give you 3.70, right? Now the next thing is DPS, that is dividend per share. It shows that it is 1.5 here. So that basically means that the company had earned a profit of 3.70 per share. So the company decided that out of 3.70 rupees that it has earned as profit per share, it would give you 1.5 rupees. Rest 2.2 rupees it would reinvest in the company. The final thing is the payout ratio, which is 0.4. The payout ratio is calculated by DPS by EPS into 100. EPS should always be positive. That shows that the company has been generating profit, right? Now, how do you know if the income statement is good? What you do is you take into consideration how the company has been doing in the previous years. And a sign of a good company would be that every year the company is growing. Every year the company is doing better. Every year the company is taking your money and working hard with your money and growing every year. That is a sign of a very good company. So if we can see here, we'll go way back to 2012 and let's check out the net income that it has generated. So it has generated 259.59 crores in 2012, 444.50 crores in 2013. That's an increase, which is good. 2014, it has again increased to 764.99 crores, very good. 2015, it again increased to 862.49 crores, very good. 2016, it approximately had 1300 crores, which is again a growth, which is good. 2017, it grew more than 1500 crores, which is again good. 2018, it almost touched 1600 crores, very good. And 2019 also it had 1613.09 crores. So you see the company has been increasing, but in the year 2020, if you see, there is a dip, which should be fine according to me, because 2020 hasn't been a good year for anyone due to COVID. There was lockdown, and obviously the sales would have gone down. So we can give the benefit of doubt to this company. So we can actually check the quarterly results of 2020. So you can click here and click quarterly here. So if you see, now this is quarterly results of this company. Now if you see, in the year 2020 March, it had a profit, it had a good profit. But in June 2020, the numbers that has been registered in June is negative 810, which is a big number. But if you consider the numbers that has been produced in June is from between March and June, and probably that was the lockdown period, and all the companies had to, a lot of things were shut down. There were no sales in many of the sectors. So this is justifiable. And if you see here, in September 2020, it has generated 337.58 crores. So that means it's again back on track to almost pre-COVID levels, which is really good. So by this, we can definitely say that Motherson Sumi Systems Limited has a very good income statement. So this would be it for this video. I hope you learned how you can go through an income sheet, or you can also call it a profit and loss statement. Thank you for watching. In the next video, we'll talk about some other statement of fundamental analysis. Till then, keep watching. Take care. Cheers. Bye.